Since ARK Invest has dropped more than 50% from its peak in 2021, many investors have sold the fund. At its height, the flagship ETF of ARK, ARKK, managed nearly $27 billion. Presently, it only manages $12 billion. The market has changed, and investors are now afraid to touch any of ARK's ETFs, and many are selling them as a result of the sharp decline in price. This defies logic because reduced pricing often translates into larger predicted future returns. Cathie Wood, CEO of ARK Invest, thinks the current market price presents one of the greatest chances in the history of the whole stock market. Similar to the dot-com bubble, but with the roles reversed, is the current state of affairs. During the dot-com expansion, internet equities increased dramatically while value stocks had a significant decline. Value equities increased in value in comparison to growth firms after the dot-com bubble. The value of Berkshire continuously rose as the Nasdaq saw a significant fall. She compares the value stocks in 2022 to the internet stocks in 1999 and the innovative stocks in 2022 to the value stocks during the dot-com boom. Although it may seem absurd, the performance differential between the two funds actually stands pretty close. ARKK has decreased by around 50% over the past year, whereas Berkshire Hathaway has increased by more than 30%. Although fluctuations in prices are fascinating to study, not everything that falls must rise again. Having stated that the macroeconomic environment is preparing for a significant rally in ARKK Invest, everyone is aware that the Federal Reserve will increase interest rates during the year, maybe as early as March. The majority of economists anticipate a rate rise of 25 basis points, or 0.25%, by March. However, some actually predict an additional rate increase. Traders are presently putting in a 30% likelihood of either a 0.5% rate rise or a 50 basis point rate hike. This is due to the fact that the most recent employment data exceeded expectations. In January 2022, economists anticipated 150,000 new employment, but the U.S. actually added 467,000 jobs. This significant disparity indicates that the economy is doing well right now. Additionally, the unemployment rate has stayed quite low at 4%. Recently, Fed Chair Jerome Powell highlighted why he thinks there is plenty of room to raise rates while the economy is still strong. Recently, Bank of America said that 7 rate increases would take place in 2022. The usual rate rise is 25 basis points, or 0.25%, thus a rate increase of 725 basis points would represent a 1.75% increase. Banks and economists are taking a really strong stance on it. The Fed's statement that it is lagging behind in raising rates was referenced by Bank of America as a portent of impending suffering. While this is going on, economic growth has already begun to decelerate. Cash, bank deposits, and easily convertible money, together referred to as M2, have all started to slow down on a monthly basis. How many rate increases will be required to battle inflation? According to Cathie, there won't need to be many rate hikes to stop inflation, and people are overreacting to their fears of rising interest rates. There are also other economic forces at play that we will shortly discuss, and these will affect how the Fed acts. If Cathie is correct that the Fed did not hike interest rates as much as most believe, ARK will undergo significant value revisions to the upside. It would be a fantastic chance to buy creative stocks if the Fed increased rates by 50 basis points in March. This is due to the fact that ARK Invest's the future would be favorable going forward, since more rate hikes may not be required. Ford stock continues to trade below its 5-year peak following the most recent sell-off. Stocks in the finance, as well as energy sectors, have also increased during the previous 12 months. The Vanguard Energy Fund has increased by 52% and the Vanguard Financials Index Fund by 28% during the past year. Clearly, slow-growing supplies cannot support such increases. This is a warning indicator that the dreaded prospect of a repeat of the dot-com boom has created a massive bubble in value stocks. Cathie used Ford's pricing and rising trend as an example of a value bubble. I was very interested after Ford said that the demand for its F-150 Lightning EV was so much stronger than it expected. Its stock exploded. Now, I want our auto manufacturers to be very successful in the EV space. We believe that the shift toward electric vehicles is accelerating here. Oil prices are one reason, but also lower prices are another as battery costs come down. Most people think that the impending rise in interest rates would somehow damage our investments. Contrarily, Cathie genuinely thinks that the only industry that will be greatly affected by rising interest rates is big tech. This is due to her belief that creative, smaller businesses may survive an increase in lending rates. The CEO of Social Capital, Chamath Palihapitiya, has also brought up this topic in the past. He claimed that he thought rapidly expanding businesses would survive a little increase in lending rates and prosper. This kind of performance is reasonable in light of big tech. If a business is expanding at an average rate of 50% a year, a 2% increase in interest rates will result in lower values and less compound interest power. However, it wouldn't have a significant effect on the business's long-term performance. On the other hand, a 2% increase in loan rates would impact a business greatly if it is expanding at a pace of 15% annually. If a business grew at a rate of 50% annually for 10 years, discounted at 10% annually, its income would increase by almost 28 times. Okay, now you might wonder, how can I calculate it by myself so that I could make my own decisions? Using the rule of 72 is a quick trick to determine how long it takes for a number to double. According to the rule of 72, the time it takes to feed a number to double in size is equal to 72 divided by the rate at which it grows. Cathie thinks she has discovered the signal that points in this direction. There has been a difference in how public and private enterprises are valued. Private market values have risen while those of the public market were corrected. This could be the case since private investors are aware that values won't be much affected by rising interest rates. Given where we are today, which areas of the market would be hurt if interest rates were to rise into the 2 to 3% region, let's say as measured by the long-term Treasury yield? And the response that I thought was most intriguing was that it would be the more established growth firms who are up against some competition rather than the super growth companies that are just starting out on their exponential growth paths. This was her idea of what is the market that affects by interest rates. She also got an example to explain the current situation. Think of early 2000s Amazon. If you had entered Amazon's revenue growth rate over the following 25 years at 20 to 30%, let's say 25%, that is what really happened. Nobody thought it was conceivable. If you were a value investor, you probably bought the stock for an entire day long based on how the cash flow patterns were forecast. Naturally, there would have been great profits. Right now, we are in the same situation with genuinely developing growth. Many individual investors who bought ARK in 2021 are now selling their holdings in the ETF. But the proper course of action is the exact reverse of that. Let's imagine that a $1,000 limited edition smartphone would be available in 2021. Let's suppose that the phone costs $500 by the year 2022. The natural course of action would be to get the smartphone now rather than before. But investors don't operate in that manner. Warren Buffett's mentor and the intelligent investor author Benjamin Graham famously characterized short-term moves as emotional and unreasonable. Stocks should be bought by investors when they are gloomy. Further research is required since that formula is not straightforward. But regardless matter how knowledgeable or experienced you have been, it's a principle worth noting for all investors. Please let me know whether you believe ARK Invest will make a significant comeback in the upcoming year in the comments section. This is the end of this video. Thanks for being to the end of the video. Don't forget to like, share, subscribe, and tell us what you think about this video below in the comments section. Let's meet again with another useful video.